The approach of "I will teach you to be rich" on personal finance and making money is different from other books in this field. It focuses on three main areas: spending consciously without sacrificing the things that bring you joy, aiming for the big wins, and finding the best types of investment for you, all while automating these subjects. While most emphasize saving on little things like eating out or spending money on Starbucks coffee that add up over time, Ramit Sethi encourages us to treat ourselves to the things we love, but cut down mercilessly on things that don't bring joy. The big brands launch a new smartphone version almost every year, and many people buy these new smartphones every year, even though their old ones still work perfectly fine, and the differences between them tend to be minor. And those who don't upgrade each year are asked by their younger siblings why they don't have it yet. Speaking from my own experience, it has become natural to spend money and then think about the future, even though not all purchases are necessary or add value to our lives. If you like holding the new iPhone in your hand and it gives you happiness in the long run, you should definitely buy it and enjoy it without mourning the money. But reduce your spending on unnecessary things that give you less joy. There is a difference between frugality and being cheap. Frugal people focus on the value, while cheap people focus on the price. Frugality doesn't mean cutting corners on all expenses. Most people wouldn't last 3 days doing that. Instead, it's about identifying the things you value and ruthlessly cutting back on the things you value less. I want you to consciously decide what you're going to spend on. Most people don't plan ahead for how they will spend their money. Instead, they tend to spend it impulsively, which eats up their paycheck. The problem is that hardly anyone is deciding what's important and what's not. Ordinary actions get ordinary results. Most people are average by definition, yet more than half of college graduates expect to become millionaires before they are 40. This is unrealistic. In the US, about 8.8% of the adult population are millionaires. In many other countries, that number is much lower. If we follow the same path as the people around us, we too will end up as average. To be extraordinary, you don't have to be a genius, but you have to take steps that vary from the norm, such as managing your finances and investing early. I think it is possible for ordinary people to choose to be extraordinary. Big wins. When it comes to saving money, big purchases are your chance to shine and outperform those who pride themselves on not ordering soda when they go out to eat at a restaurant, but end up wasting thousands on big purchases like cars, expensive clothes, or a house. Large purchases can result in significant savings, such as $3,000 on a car or $50,000 on a house, making small attempts to save seem insignificant. However, mistakes are often made when buying expensive items. Imagine how many cups of coffee you can order if you save a few $1,000s when buying a car by comparing prices in advance and thus negotiating better. While frugality is admirable, it is important to prioritize the activities and purchases with the greatest impact. The big wins. Aiming for the big wins is much more efficient than focusing on 100 small things. Prioritize. While people spend hours cutting coupons, they're failing to see the bigger picture. Keep things simple and efficient with the 80% rule. This applies not only to savings, but also to the income aspect. For example, when searching for the best savings account or investment option. Focus on the big items. Get 80% right. Once you have implemented the simple steps and everything is up and running, you can always try to improve returns and aim for the final 20%. This will help you stay motivated and on track. And if you think it's worth the effort, you can still search for a savings account with a 0.1% higher interest rate afterwards. Do less but make it sustainable. Do you know people who are so focused on details that they eventually lose motivation? And then they have to run twice as fast to catch up. Save for a goal. Saving with a goal puts all your decisions into focus. If you don't want to make major purchases, you can also decide to save some amount before a certain date. The main idea is that you have a goal. Sethi recommends setting up a system where you automatically save for your financial goals and then spend on the things that truly bring you joy. He suggests using the 50-30-20 rule, which involves allocating 50% of your income towards necessities, 30% towards guilt-free spending, and 20% towards savings and investments. Also, have you heard about the 95% rule? So, if you are included in the 95% of viewers who aren't subscribed yet, go ahead and make it the 5% rule by subscribing. It's completely free and helps out a ton. Lastly, feed a like to the algorithm. And without further delay, we'll continue. You don't have to become a financial expert to get rich. When it comes to our finances, most people tend to fall into one of two categories. Either we ignore this aspect completely and do nothing, or we focus like crazy on the details like interest rates and the economic situation, but fail to take any meaningful action. Unfortunately, both approaches lead to the same result: no progress toward our financial goals. To improve our financial situation, we should consider automating our cash flow and investing in a few long-term investment opportunities. But instead of taking these practical steps, we often get caught up in endless debates about economic predictions and rely on hot stock picks with hardly anyone held accountable for their recommendations. We'd rather debate minor issues than act ourselves. Remember the last time you talked to a friend about finances or fitness? Did you take concrete steps to achieve your goals afterwards? Or was it just a discussion about small details? You don't have to be an expert to get rich. You don't have to be a professional chef to cook mac and cheese. Once you've made your first meal, you'll gain confidence and dare to tackle more challenging recipes. The key to building wealth is to take action, not to be the smartest person in the room. Instead of being upset about the economy, focus on the things you can control. Take small steps and limit the number of options that can leave you feeling overwhelmed. Some are afraid of losing money, which is understandable given the market fluctuations during the financial crisis or pandemic. After repeatedly hearing the media's alarming reports about financial crises, one may be tempted to ignore stocks entirely. However, a decline in the stock market can actually benefit investors. This is because stocks are available at a discounted price, allowing us to purchase them now and hold on to them for years to come as they increase in value. It's important to take a long-term perspective and consider different investment options with varying levels of risk. Also, keeping your money in a checking account will cause it to lose value over time due to inflation. Fear shouldn't stop you from doing something about your finances. I like to illustrate this with some numbers from another book I made a video about. On average, the historical odds of earning a profit in the US stock markets are 50-50 over 1 day, 68% over 1 year, 88% over 10 years, and, so far, 100% over 20 years. This is no guarantee for the future, but the chances are good to earn significantly higher profits on the stock market in the long term than to keep the money hidden under the mattress. Everything worth pursuing has less than 100% odds of succeeding. Investing is the most efficient way of accumulating wealth. Creating an investment account provides access to the largest wealth-building mechanism in history, the stock market. This is a crucial step towards investing, and it doesn't require significant wealth to get started. This is when you get access to passive income and the compound interest effect. Compounding is mankind's greatest invention because it allows for the reliable, systematic accumulation of wealth. The biggest financial concern Americans have is not having enough wealth for retirement. But unfortunately, the truth is that if you only do the bare minimum, such as saving $100 per month in a savings account, the outcome won't be particularly impressive. That's why the book puts so much emphasis on investing. And especially if you are just starting out on your financial journey, there are a few ways to increase your return without taking any additional risk. Let's have a look at this. You can maximize the benefits of your employer's 401k match by contributing just enough to receive 100% of the match. With a 401k match, your company matches your contribution up to a certain amount for every dollar you contribute to your 401k. If you make $100,000 and your company offers a 100% match up to 5% of your contribution, you contribute $5,000 and your company matches that amount by another $5,000. That's essentially free money, making it the best risk-reward ratio there is. Paying off credit card and other debt isn't investing, but it can give you significant risk-free returns. The average APR for credit cards is around 24%, and many interest rates are higher. Regardless of what your credit card company charges, paying off your debt will give you a substantial return right away. Paying 24% less interest on your credit card is the equivalent of investing for a 24% return, except it's risk-free. Pay your debt off aggressively. Although 75% of Americans claim they only make major purchases on their credit cards if they can pay them off immediately, spending patterns show that 70% of Americans carry a balance on their credit cards. Even more surprising is that of the Americans who carry a monthly credit card balance, half of them make only the minimum monthly payments. A good credit score has a much bigger impact on your finances than saving a few bucks by not eating out anymore. That's because a good credit rating makes you less risky for lenders, which leads them to offer you lower interest rates on loans. This can make the difference between a 3% and 6% interest rate. People with good credit ratings save tens of thousands of dollars. On a $400,000 mortgage over 30 years, this can be the difference of $200,000 in total interest compared to $460,000. If you are currently struggling with credit card debt, you face two major problems. First, you are paying a lot of interest on the amount you owe. Second, this will likely negatively impact your credit score, as 30% of your score is based on your debt. This can lead to a vicious cycle where you may have difficulty obtaining a loan for major purchases such as a house or car, and pay even higher interest rates due to your poor credit score. Many people classify debt as good or bad, depending on whether the debt increases in value over time, such as for an education, or decreases in value, such as for a car. And yet, think about it. Is it really normal to owe more than you have? While it may make sense to go into debt for certain investments, such as a house or an education, it may not make sense for meaningless purchases made with a credit card. Consider opening a Roth IRA and maximize your contributions. A Roth IRA is a special type of retirement account that requires you to pay taxes on the money you deposit, but all future withdrawals are tax-free. This can result in significant tax savings, especially if tax rates increase in the future. If your income is $153,000 or less, you can deposit up to $6,500. Once the funds are deposited, there are several investment options, including stocks, bonds, ETFs, and even cryptocurrencies. Asset allocation should be the major focus of your investment strategy because it is the only factor affecting your investment risk and return that you can control. The pyramid of investing options illustrates the range of investment choices available, with stocks, bonds, and cash at the base level. Above them are index and mutual funds, followed by lifecycle funds at the top. Each category, also called asset class, offers unique features and benefits. Investors typically expect their stock investments to perform well when the company performs well. If you have a high risk tolerance and can withstand market fluctuations, stocks can be a beneficial long-term investment. Bonds are low-risk investments, but the returns are lower on average compared to stocks. This raises the question of who would choose to invest in bonds. Generally, wealthy and older people who value maintaining their money and seek a stable, almost guaranteed return. Keeping cash on hand for emergencies or as a hedge against market downturns is important, but it comes at a price. If you keep your money in cash, you actually lose money over time, taking inflation into account. You should have cash for 3 to 12 months of expenses, depending on which book you read on the subject and what gives you peace of mind. Index and mutual funds allow you to pool your money with other investors to buy a diversified portfolio of stocks, bonds, or other assets. Index funds track a specific market, while mutual funds are managed by fund managers who try to outperform the market. Index funds typically have lower fees than actively managed funds, making them a popular choice for investors who don't want to pick stocks themselves. A lifecycle fund automatically adjusts the mix of investments over time to reflect the investor's changing goals and risk tolerance as they age. As the investor gets closer to retirement age, the fund becomes more conservative, holding a higher portion of fixed income investments and a lower portion of stocks. They provide diversification and convenience for investors who prefer a hands-off approach. You should decide how you want to allocate your portfolio based on your age and risk tolerance. Depending on when you watch this video, I already have a separate video on this topic and how the most successful investors of our time allocate their assets. Set up your automatic money system. Your financial management should be automatic, requiring no conscious effort from you. By setting up automatic payments for your savings and investment accounts, your contributions will grow passively without requiring any action from you. This approach makes it harder for you to stop contributing to your freedom, not because it's impossible to adjust the system, but because it would require effort on your part. If you want to build wealth over your lifetime, the only sure way to do it is to get your plan on autopilot and make everything that's financially important in your life automatic. Link your accounts and set up automatic transfers from one account to another. You can link your paycheck to your 401k account, your checking account to your savings account, and your checking account to your investment account or Roth IRA. You can even link your credit card to any bills you've paid through your checking account. If you're still writing checks with a pen to pay your bills, it's time to embrace modern technology, considering the advances we've made from fire to electric light. And if you're now wondering what to watch next, have a look at this video on screen I handpicked for you. Anyway, thanks for watching. Like and subscribe.